You know, when you walk into a flawlessly staged open house, the vanilla candles are burning, the natural light is hitting the hardwood floors just right, and you are ready to make a cash offer on the spot.
Right. The curb appeal is blinding.
Exactly. And that is exactly what Netflix's Q1 earnings report looked like this week. Just a flawless $12 billion facade. But then you get your hands on the inspector's report, right? And you realize that fresh coat of paint is actually hiding a severely cracked foundation.
And suddenly the asking price feels entirely different. Because look, you cannot hide structural realities from algorithmic trading or from institutional analysts.
No, you can't. Welcome to today's Deep Dive. We are looking at a massive stack of financial reports, Q1 2026 earnings transcripts, analyst notes, and media strategy interviews, all centered around one ticker, Netflix.
The big one.
Yeah. And our mission today is to strip away the hype. We're unpacking these numbers like a desk of hedge fund analysts. We need to understand this wild earnings paradox, the massive insider sell-offs we just saw, and the actual forward catalysts.
Because that's what will define their survival in this newly consolidated landscape. And the setup here is fascinating because of the sheer whiplash.
Oh, the whiplash is insane. Let's start with the headline numbers because they looked absolutely bulletproof.
Unbeatable on the surface.
Right. Q1 2026 revenue grew 16% year-over-year to $12.25 billion. Diluted earnings per share came in at $1.23.
Which, by the way, completely obliterated the Wall Street consensus. I mean, they were forecasting, what, 76 cents?
Exactly, 76 cents. They crushed it. And on top of that, free cash flow surged to $5.1 billion. By any traditional metric printed in a press release, that is a spectacular home run.
Yeah, but here is the reality check. The stock instantly tanked 9.7% in after-hours trading.
Dropped straight down to 97 bucks and change.
Right, down to 97.35. So if you're holding this in your portfolio, you are staring at the screen wondering, how does a company beat earnings estimates by that much and still lose a tenth of its market cap overnight?
Makes no sense to the casual observer.
It doesn't. But there is a massive contrarian edge here that everyday investors completely miss when they just, scan the financial news apps. The professional money stripped out the noise.
Walk us through that. What did the smart money see?
They saw that the massive EPS and free cash flow beat was not from explosive organic growth. It was heavily, heavily inflated by a $2.8 billion termination fee.
Wait, the termination fee because Netflix's attempt to buy Warner Bros. Discovery fell apart?
Precisely. The mega merger died, and they received a $2.8 billion cash windfall. From an accounting perspective, that money just gets recognized in interest and other income.
Wow.
Yeah. So when you remove that one-time windfall from the ledger, the core operating profit is fine, but that $5.1 billion free cash flow number suddenly looks heavily manufactured.
I mean, Wall Street knows you cannot rely on failed acquisitions as a recurring business strategy.
Exactly. It's a one-off.
It's the equivalent of getting a massive bonus at work because a house purchase fell through and your escrow deposit was refunded.
Right. You look incredibly wealthy on paper this month.
But your actual recurring salary hasn't changed at all. And the market is always forward-looking. Wall Street immediately moved past that Q1 mirage and looked directly at the Q2 guidance.
Which was incredibly soft. This is where the narrative really falls apart. Management is guiding for an EPS drop down to 78 cents and revenue of about $12.57 billion.
That is a massive sequential drop in profitability.
Huge.
But wait, I have to push back on the mechanics of that drop for a second. If their core business, adding subscribers and raising subscription prices, if that's still fundamentally growing, why is Wall Street punishing them so harshly for a conservative Q2?
It's all about the margins.
Right, but where is that profit margin vanishing to?
It is vanishing straight into content amortization. Netflix explicitly warned that their operating margins are going to get severely squeezed in the second quarter because the accounting bill for their massive content library is finally coming due.
Okay, let me make sure I'm conceptualizing this correctly.
Yeah.
Because amortization is the absolute heartbeat of their financial model.
It is the whole ballgame.
Right. So if Netflix spends $100 million producing a massive sci-fi blockbuster today, they do not take a $100 million hit on their profitability sheet today.
Correct. The cash goes out the door to the directors and the crew.
But the actual accounting expenses spread out over months or years, matching how long they expect that movie to actually drive viewership.
Exactly. The math backs you up perfectly. That's the matching principle in accounting. Management noted that due to the specific timing of their title launches, Q2 is going to experience the highest year-over-year content amortization growth rate of all of 2026.
Oh, wow. So the ghosts of past content spending are coming back to haunt the Q2 balance sheet.
You nailed it. So investors are staring at a Q1 artificially inflated by a breakup fee, followed immediately by a Q2 weighed down by the rising accounting costs of producing television.
Which logically triggers a massive sell-off when you factor in the multiple the stock is trading at. I mean, even after that 10% haircut, Netflix's price-to-earnings ratio sits at a lofty 42.60.
And their forward PE is 37.17.
Yeah. If you are an everyday investor holding this stock, a 42 PE means you are paying $42 today for every $1 of earnings the company generates.
It's a massive premium valuation.
Right. Legacy media companies traditionally trade at a PE of, what, 10 or 15? You only pay a 42 multiple if you are pricing in aggressive, uninterrupted hypergrowth. Any sign of margin compression shatters that illusion.
And analysts are deeply divided on whether that multiple is defensible right now. China Renaissance just raised their price target to $100, but, and this is key, they maintained a hold rating.
Which essentially implies there's zero upside left in the near term.
Exactly. Conversely, the broader consensus target remains elevated at $114.82, keeping a moderate buy rating. The street genuinely does not know how to price this transition.
The valuation debate is intense, but look, the governance shock is what really changes the temperature in the room for me.
Oh, absolutely. The Reed Hastings news.
Yeah. Co-founder Reed Hastings announced he will not stand for re-election to the board in June. I mean, he is the visionary who transitioned this company from mailing DVDs in red envelopes to pioneering the entire global streaming industry. Losing him is a seismic shift.
The symbolism is heavy, sure, but the financial mechanics of his exit are what truly spooked retail investors.
Because he sold.
He didn't just sell. Hastings just liquidated 420,550 shares on the open market. That transaction was worth roughly $40.16 million.
Wow.
Yeah, and it reduced his direct position in the company by over 99%.
He practically zeroed out his direct holdings. And he's not the only executive taking cash off the table, right?
Yeah. Nope. Chief Financial Officer Spencer Newman also sold over 57,000 shares, cashing out roughly $5.4 million.
Executives selling stock always sends a specific, highly scrutinized signal to the broader market. And I am looking at this through the lens of a retail shareholder.
Right. Put yourself in their shoes.
I see the visionary founder and the chief financial officer cashing out tens of millions of dollars at the exact moment. Near-term growth looks shaky, and operating margins are getting squeezed by amortization costs.
It looks terrible.
It does. Why should I hold the line and defend a 42 PE multiple when the actual architects of the balance sheet are heading for the exits?
It's a completely logical panic response. But, and here is the contrarian edge for the segment to find the real story, you have to look at the other side of the trade.
Who's buying?
Exactly. Every time an insider sells a share, someone else is buying it. And in this case, the buyers are massive institutional heavyweights. In Q4, institutions like Vanguard and State Street increased their stakes in Netflix by over 900%.
Wait, 900%? Increasing a position by 900% is not just, rebalancing a portfolio. That is backing up the truck and taking physical delivery.
Absolutely. Institutional ownership of Netflix now sits at a staggering 80.9%. The smart money is absorbing every single share. Hastings and Newman are unloading.
Okay, so how do we reconcile those two opposing forces? The founder drops 99% of his direct stake, while index fund titans increase theirs by 900%.
It comes down to identifying where Netflix actually sits in its corporate life cycle right now. Retail investors are panicking because they still view Netflix as a hypergrowth tech startup that needs a visionary founder to disrupt the world.
And Vanguard?
Vanguard is buying because they realize the tech startup era is dead. Netflix has officially transitioned into a mature, cash-generating media utility.
A utility, like a telecom company or an energy grid.
Precisely. Vanguard doesn't need Reed Hastings to invent a new industry anymore. They just need competent operators to manage the digital pipeline and throw off predictable cash flow.
That makes a lot of sense. You look at the fundamentals of utility. They require massive upfront capital expenditures. In this case, billions of dollars for content.
Right.
But once the infrastructure is built, They have immense pricing power over a captive audience.
Exactly. But a utility still has to grow revenue to satisfy Wall Street. And with subscriber growth maturing, I mean, they are approaching 1 billion viewers and 325 million paid subs globally. They are running out of broadband households to conquer.
They've saturated the map.
They have. So they have to prove to these institutional investors that they have aggressive new levers to pull to justify trading at a tech multiple while operating like a legacy utility.
And the primary lever they are pulling is advertising.
Right.
The monetization pivot happening inside Netflix right now is just staggering. Management reported that their ad-supported tier now accounts for over 60% of all new signups in available markets. Yeah. The ad tier is no longer a fringe, budget-conscious option for college students. It has fundamentally become the primary onboarding ramp for the entire platform.
And the revenue targets reflect that new reality completely. Netflix is on track to hit $3 billion in advertising revenue by 2026.
Which is double what they pulled in during 2025.
Exactly. They now boast over 4,000 advertisers on the platform. That's a 70% year-over-year increase.
But scaling an ad business that fast requires infrastructure.
Yeah.
You cannot hire enough human sales representatives to manually negotiate 4,000 ad contracts.
No, it's impossible, which explains why they are aggressively expanding programmatic buying through the Amazon demand-side platform.
Oh, the Amazon DSP.
Programmatic execution is the critical detail here. Integrating with Amazon DSP means advertisers no longer have to call a boutique Netflix sales team to negotiate a premium campaign. They just use automated algorithms to bid on Netflix inventory in real time.
Which completely removes the friction of the transaction.
It commoditizes the inventory.
Right. It turns a Netflix ad from a bespoke, high-touch luxury purchase into a standard automated line item on every major corporate media plan in the world.
Exactly.
But look, that creates a secondary problem. If ads are the new revenue engine, you need to guarantee that users actually stick around to watch them. You cannot build a $3 billion ad business if your users binge a show over a single weekend and then cancel their subscription for 3 months.
You have to solve the churn problem. You need appointment viewing. You need content that forces the viewer to remain subscribed month after month after month.
Which brings us to the live sports strategy. Chief Content Officer Bella Bajaria is not just dipping her toes in the water here. Her stated strategy is literally go big or go home.
And we are seeing that thesis execute in real time. The initial data is overwhelming. Look at the World Baseball Classic.
Oh, the Japan numbers.
Yeah. They aired the WBC in Japan, drawing 31.4 million concurrent viewers. That single live event struck the largest sign-up day in the country's history.
That's incredible.
Because of that baseball tournament, Japan became Netflix's single largest contributor to member growth in the first quarter.
It is a brilliant mechanism for localized market penetration. And they're scaling it globally with massive cultural events. I mean, they secured the heavyweight boxing match between Tyson Fury and Anthony Joshua.
Yep.
They are broadcasting an NFL Christmas doubleheader that features a halftime performance by Beyoncé.
In the media industry, live sports are often referred to as the best soap opera because they're unscripted, highly emotional, and most importantly, they are DVR-proof.
You cannot time shift a live heavyweight title fight.
No. If you try to watch it 3 hours later, the result will already be spoiled on social media.
It forces synchronized, simultaneous viewing. But, I mean, there is a massive historical irony embedded in this strategy.
Oh, definitely.
Think about the original Netflix value proposition. They were the ultimate Silicon Valley disruptor. Their entire promise to the consumer was watch what you want, when you want, entirely without commercials. That was the exact weapon they used to bankrupt Blockbuster and cripple traditional linear television.
The original vision was an on-demand, ad-free utopia.
And today, the primary growth engines that Vanguard and State Street are betting billions of dollars on are scheduled live sporting events and ad-supported viewing tiers. The disruptor has literally become the disrupted.
This is wild.
Are they actually winning the streaming wars, or are they just mutating to survive an existential threat?
The market data suggests they are mutating purely out of defensive necessity. Look at the competitive landscape it's consolidating rapidly, creating apex predators that Netflix simply cannot ignore.
Right.
Remember the $2.8 billion breakup fee we discussed earlier? Netflix walked away from Warner Bros. Discovery, but a legacy titan did not.
Paramount Skydance swooped in.
Exactly. They agreed to acquire Warner Bros. Discovery for an earth-shattering $110 billion.
Just a monster deal.
Look at the market share math of that mega merger. Combining Paramount, CBS, HBO, Warner Bros., and Discovery under one massive corporate umbrella gives the new entity a 22% share of the United States streaming market.
Wow.
That ties them perfectly with Amazon Prime Video for the #1 spot, and it slightly edges out Netflix, which currently sits at 21%.
So Netflix has officially been pushed down to the bronze medal podium in U.S. market share. They are suddenly the underdog again.
And it perfectly contextualizes why they are pivoting so violently into live events and advertising.
They have to protect their digital turf against a combined Paramount-Warner juggernaut that possesses decades of institutional experience in monetizing live sports and ad-supported television.
Exactly. The competitive moat that Netflix built over the last decade was predicated purely on ad-free, on-demand binge watching. That moat is no longer wide enough to keep the market at bay. They have to play the legacy media game, but they have to execute it with Silicon Valley technological scale.
It is a clash of titans, and the financial gravity of the situation is just immense. Look, we have covered a massive amount of technical ground today, from margin compression to programmatic ad algorithms. If we synthesize the earnings beat, the soft Q2 guidance, the executive exodus, and this defensive strategy, a unified thesis emerges.
The narrative is clear. The hypergrowth tech startup era of Netflix is permanently closed. The departure of Reed Hastings is the ultimate punctuation mark at the end of that chapter. Today, Netflix is a mature, massive media utility navigating an incredibly precarious transition.
They're walking a financial tightrope. They have to balance the heavy, front-loaded accounting costs of content amortization against a market that relentlessly demands expanding profit margins.
Right.
They're navigating a symbolic leadership transition while simultaneously fending off fierce, newly consolidated mega competitors like the Paramount-Warner alliance.
And to survive that gauntlet, they are aggressively pulling the levers of traditional broadcast television. They're squeezing billions of dollars out of programmatic advertising algorithms and locking transient audiences into the platform with live appointment viewing sports.
It's the only mathematical way they can justify holding a 42 PE ratio when their total addressable market of broadband households is already heavily saturated.
Exactly. If you remember one thing from all of this, it's this. The market isn't pricing Netflix on its history of disruption anymore. It's pricing them on their ability to execute a legacy media playbook better than the legacy media companies themselves.
Which brings us back to that perfectly staged open house. The physical house is still standing. In fact, it's a fortress. But you are no longer buying a brand new modern build with infinite upside. You are buying a historic estate that requires a massive amount of expensive ongoing upkeep, and the new property managers are completely gutting the original floor plan just to make rent. And that leaves a lingering question for you to mull over the next time you log in to watch a show. As Netflix leans heavier and heavier into ad tiers, live sports, and scheduled programming to satisfy Wall Street's relentless demand for revenue growth, haven't they slowly just reinvented the exact traditional cable TV bundle they originally set out to destroy?